What's up, everyone, and welcome to the Life Cycle of a Trade, the series where we break down the thought process behind trade entry, trade management, and closing order. In this episode, we will cover a put ratio spread. I'm looking at something that's kind of been a hot topic recently, talking about uranium and alternative energy and whatnot. So these stocks have really gone parabolic, so to speak. If you look at URA, it's one of the ETFs that tracks the uranium space. It's had a really significant rally to the upside here. CCJ is kind of the most tradable of the bunch here. It's been a stock that people have suggested to me to look at for the last couple weeks here. I think it's an interesting one just given that it trades at about a $50 price tag. It's a relative kind of mid-cap stock here at $22 billion. Does have earnings coming up in November, so that's something to consider, but I think it's liquid enough and small enough for me to put on a position here. And I'm looking to do something that I haven't done yet in this portfolio, which is regular ratio spreads. So we've done some broken wing butterflies, which are very similar to ratio spreads. They're just defined risk. With the ratio spread, you actually have a naked position. So how you'd set this up is you are long one option closer at the money, short two further out of the money options. You use those two short options to finance buying that long option. It gives you a risk profile very similar to a ratio spread. So for me here, I'm looking at a downside ratio spread. The stock has had a significant rally here. It can go higher, of course, but I'm going to play for maybe a sideways / slightly lower move in CCJ after the move that it's had here. So here, I would look to go around the 30 delta for the long option, maybe this 34 strike, this 34 delta here at 70 or at 48. You could look at the 47 if you'd like. Not much of a difference there. For me, you want to collect about $1 on each option so that you're offsetting the total cost of this long option. So here we would go to like the 46 strike and do two of those. So you can see this routes at a net credit of 59 cents. It's a relatively tight range to hit on the downside. If you wanted to, you could move this to the 45 and do this for a penny or two credit. You could move this down to the 47 strike if you want to be a little bit more conservative here. This gives you a break even down at 43, and that's because you have this embedded long spread here. So you're long this 47, short the 45 long put spread, which gives you a $2 range to the downside plus that credit that you're getting on entry. We can look at this on the analysis mode as well. If we go to the at expiration here, you can see you get that little extra pop of profit potential on the downside if you do get a little bit of a move down. You have no risk to the upside, and you'd keep that 40 some odd cent credit if you do get filled somewhere around here. So it's an interesting trade to have no risk to the upside, but have an extra potential profit potential to the downside here. So we're going to route this here. Let's try it like 45 cents is where I thought I'd get filled here. No fill on that. You can see the markets are a little wide here, 10 cents-ish on each one. Let's go to the 43. There we go. So we're in for a 43 cent credit here. The interesting part of this trade, too, is that you are naked a put. Synthetically, that's your risk here. So you do have the option to sell a call at some point if you'd like to collect a little extra premium here. It will give you risk to the upside, though. So maybe if we do get a little bit of a rally here, I'll sell out that call. But we'll see if that happens in the next couple weeks here. All right, so we've got an interesting position here with a couple of different options that we can play into right now. No pun intended on that. So CCJ is a uranium stock and a uranium play, and it's been on an absolute tear to the upside. $58 is where it's trading now. So the stock's gone up $8. A put ratio spread and a broken wing butterfly are omnidirectional trades where the put ratio will actually have long delta to start because you're doing this for a credit. We did it at a 43-cent credit where you're selling 2, buying 1, and you're doing this for a net total credit on the position. You're going to have long delta, which means that you technically want the stock to go higher. But when you look at a risk profile of the position, your max potential profit, and if we do the Theo or at expiration here, we could see the analysis mode here. Your max profit is actually against your delta. So this is a dynamic delta position as the stock, or if the stock had gone down and time passes, you'll see your delta actually flips from long to kind of flat / short as time passes if you are somewhere in this area of the ratio spread. So this position right now, the way you can look at this is that you could close this position out just by buying the 2 and selling out of the 1 for a small debit, a 9-cent debit here, or 10 cent depending on where we get filled, and keep that $34 in profit. Now, I would usually say this is probably the route to go, just to free up the capital. You get your $500 back, you take your $30 or $40 in profit, around 8 to 10% return on capital. Nice trade in the books. You could certainly do that. If you wanted to take this position, we've done this with broken wing butterflies. One of the things you can consider, and going back to the analysis mode, is where your risk is on this position. So you can see we have no risk to the upside. We'll keep that 43 cents if the stock stays above our short puts at 45. But you can see we have risk below around 43, which is very far out of the money. Granted, it's 15 points out of the money. But it's very cheap to keep this as sort of a lottery ticket. And the way you can do that is similar to what we did with that broken wing butterfly in Tesla, is that you can buy in that risk. So there's 2 ways you could do this. You could either buy the 43 strike put. Buying this put for whatever debit you can pay here. The markets are pretty wide here, so I'm imagining that you can get filled closer to 10, maybe even below 10 on this position. Buying in this put to make this an equal with butterfly. So what this would leave me with would be a long 47, short 2 of the 45s, long 1 of the 43s. So this sort of position I would have on, if I do it, let's say for a 10-cent debit, I would have this butterfly on for a net 33-cent credit, a long butterfly for a credit, which means I'd be closing the position if it does come into value, if the stock comes down, for another credit. So it would put me into a position with basically no potential loss in principle based on my position that I put on originally. You can see it would also free up capital. The other way you can address this position, or give yourself a kind of lottery ticket type position, is just to buy in the risk completely. So when you think about this position, I'm short an extra put. This long put spread uses no capital because I put the original trade on for a credit. I sold that put to finance buying the long put spread. So if I can buy this 45 strike put, just one of the contracts, for less than my credit, I'll have a net credit of profit with no risk going forward and a $2 potential profit or some additional value if the stock were to come down. So this is the move that I'm actually going to take on this position. And the reason is just because the bid-ask spreads are all wonky on this 43 strike. So I'm just going to buy in this 45 strike put for, let's try and do it for under the mid price here, and we'll work our way here, for 16 cents. And that'll basically close out of the risk of the position. You could see I'd be closing out and freeing up $450 of buying power here. So let's see if I can do that. No fill there. Now, the probability of getting to this spot is about a 10% probability. When you look at the delta, the probability of touch of a position is about 2 times the delta. That's a little trader hack. So very small probability that this will actually come into play for me in terms of being profitable on this position. But, or I shouldn't say profitable because I am profitable. getting more profits out of this position. Very, very small shot. But for me, I don't mind risking the 18 cents to potentially make 50 cents or $100 on this position if we do get that move lower. So now I've got this long put spread on, which is long the 47, short the 45. I've got this on for a net credit of $33. So I've taken in 33 cents. That is value that I've captured, and I'm long this put spread. Now, if you want to get even more risky, you could just buy back this put, and you basically own this long put for free for the next 25 days. So you can think about doing that if you want to take an extra spicy lottery ticket. But for me, this position is done with. It's closed. It's a 33-cent profit. It'll very, very likely expire worthless. We could take a look at this at expiration, just kind of walk through that position as well. But it gives you a lottery ticket if we do drift lower from here. So we'll see if we get a little bit of a pullback on that position. It's dropped about $6. We had this put ratio spread. So that put has gone from 18 cents to about 35 cents. So it saved us about 17, 18 cents, which is marking us at a value right here of this far out of the money put spread of 36 cents. We had this on for a net credit of 25 cents. We had no risk on this position. It was a free shot. And we've talked about this before. You know, I wasn't expecting it to get to 45, but if we had a little bit of a down move, this spread might add some value to my position, and it has today. And so we're sitting here at a 34, 35 cent credit, depending on where we can get filled here for this leftover long put spread. You could certainly leave it on and let this go to the next 15 days. The only risk you have is this value that it's trading at right now of 33 cents or wherever we get filled here. You can see the markets are moving around pretty significantly. But for me, just given this move that we've had, about a $6 or $7 down move here in CCJ, I think I'm going to try and just take my profits here and move on to something new. So something happened here. You had some wide bid-ask spreads. This one just widened out here. I'm going to start this at where we were marked before at about 34 cents. And see if I can get filled here. It's not uncommon to have far out of the money options kind of have wider bid-ask spreads, and CCJ is not one of the most liquid underlying, so this isn't total shock. We're going to just work this down from here because I'm not trying to get the 11 cents. I think this should trade more so around like 25 cents would be my guess. Let's see, but we're going to work it, and we're going to try and get filled here. Nope. Oh, there we go. All right, so we worked the order down to 28 cents, more than I thought we would get out of this position. This position was one that we legged out of the naked put. We left the long put spread on. That long put spread added another 20, 30 cents in value. We exited this position at a $53 profit. So a nice little trade, kind of just playing the back and forth in the market. We look at the chart, we kind of top ticked it based on when we bought back that put. Got a nice down move back to, where we originally started the trade. That value came in. We took those profits, moved on to the next trade. So good little trade for the Johnnies.